Christina, let's start with you. Given that what we're having with inflation, trying to get under control, what the Fed is doing, what does that tell investors? Should they be doing right now?
So, David, what I think is it's telling investors right now is that there is an awful lot of uncertainty out there. We don't know what the Fed's going to do. Sarah and I differed in what we expect, and I think that's very, very true. Markets don't know what the Fed is going to do. And in addition, what we have is this big unknown about the debt ceiling. And will it be easily resolved, or will it be a problem like it was in 2011? And could it be even worse than what we saw in 2011? So this is an environment that I think you want to be defensively positioned in tactically, though, waiting for a change. And what is that change going to be? Well, to make sure the banking crisis is behind us, and also, of course, making sure the Fed hits the pause button and we are poised. That, to me, means we'll be poised for a different market environment, one that tends to be more risk on.
Christina, when you say defensively, I think cash. Money markets are returning some pretty nice returns right now. Are you talking cash?
I am not talking cash. I'm talking about within equities being more defensively positioned in terms of technology, healthcare, consumer staples, utilities. Within fixed income, being more cautious, having investment grade credit. So within alternatives, overweighting gold and underweighting cyclical commodities. So that to me is being defensively positioned, but also recognizing that this market regime could turn soon if we get that pause and if we get more clear signs that the banking crisis is behind us.
So, Sarah, you're a chief investment officer at Nuveen. Where are you putting your money?
We're advising our clients. Overall, our theme is quality, making sure you own companies that are resilient and can survive lower earnings and a recession. So starting with equities, dividend growers. These companies tend to increase their dividend over time, so it gives clients income. And also, they tend to have strong balance sheets and strong free cash flow because they're able to grow their dividends. Surprisingly, we also like emerging markets. That's an area that we don't think of as sort of low beta, but with China reopening and the dollar likely weakening as the economy slows in the U.S. and valuations on their side, we like emerging markets for a little more bang for your buck. In fixed income, we're looking at high quality, high yield, again, the quality theme, and also BB rated corporates where you can reach for yield and get a little stronger return. And then real assets are interesting. Our top pick coming into this year was infrastructure. The components of that are waste management and utilities. Even during a recession, we take out our garbage and we still turn on our lights, so that tends to be a recession resilient sector going forward. Those are the areas that we like across the board.
So, Sarah, just to press you a little bit, do you have any good examples of what you call dividend growers?
Sure. So it's across the board. It's not growth versus value. A company like Linde, which is an industrial gas company, they tend to have strong margins, strong pricing power, high quality company, and nice yield. These are the companies that we like going. Morgan Stanley is another company. We just talked about that within financials. That's our, the company we like in a sector where we're not as positive on, but they have a nice dividend yield. All these companies that have a nice yield and also tend to increase their dividend going forward are companies that fall into the dividend grower category.
So, Christina, there's a lot of talk about earnings recession right now. Some people even think we're already in one. Do you anticipate an earnings recession? And if you do, what does that tell you as an investor? What should you do about it?
Well, I think there definitely will be an earnings downturn. I mean, that has to happen just given that the U.S. economy is under pressure. I don't know if it'll be a technical earnings recession, but it really doesn't matter because as we know, markets tend to discount out 9 to 12 months. And we also know that historically, when rates go down, that's a period in which we see multiple expansion. So I think that will be a countervailing force to the downward pressure exerted on stocks because earnings are disappointing in the next several quarters.
So, Sarah, let me come back with a version of the question I asked Christina. That is to say, if in fact we think there's going to be a downturn in the earnings, we've already seen some of that already, should you really be in cash? You can come in and buy it at the right time.
So cash is interesting in the sense that we do acknowledge that it is paying a reasonably high interest rate right now. The issue with holding cash is trying to time the market to get back in. So for example, over the last 30 years, if you missed the 10 and 20 and or 20 best days, you'd underperform the benchmark by about 50 to 73%. And that's the issue. We saw it during the pandemic where the market bottomed in March 2020. I don't think anybody thought that would be the bottom, and then it was off to the races from there. So our view is more that you want to own quality, average back into the markets. Just stepping back, you mentioned an earnings recession. I think we're already in one. This is going to be the second quarter of negative year-over-year earnings growth, which is an earnings recession. What we're worried about with earnings going forward is, of course, that revenue growth, which is expected to be about 2% this quarter. I think it's going to be tough for companies to hold on to that because of their inability to hold on to pricing power and the economic slowdown.
Quickly here at the end, Christina, what about that? Should investors be afraid of missing out? Should this be a FOMO time because they're worried if they're out of the market, they can't get back in?
Absolutely. The hardest thing about investing is market timing. So I think it's always better to be strategic, well diversified, and just enjoy the ride.